Welcome back, everyone. This is going to be part 4 of a 4-part series that I'm putting together on trading options in Robinhood for beginners. So if you have not checked out the previous 3 videos, please do so. I'm going to put a link to the first one up top here so you can follow along and start from the beginning if you haven't been able to watch the previous 3. In this video, we're going to talk about the options terminology and talk about some of the details about how these premium prices and strike prices all get created and what goes into them. So it's a little bit more detailed than we've gone into in the first 3 videos, but those first 3 videos kind of set you up for understanding this one. Again, I really appreciate everybody. If you could subscribe to this channel, follow along, follow all my videos. If you like a video, please click the thumbs up. Add as many comments as you would like. I really encourage you to comment and let me know how I can make these videos better, make them more valuable for you. If you would like to support me and this channel, in the description are my referral link to Robinhood, as well as my Venmo account that you can, send some donations into to help support this channel and my Discord group as well. Okay, so today we're going to talk about the options terminology. And right off the bat, I'm not going to cover things like implied volatility, because we covered that in video number 3. I'm not going to talk about chance of profit, right? Not really needed. I'm not going to talk about row. Everything else I think I'm going to cover today. The bid, and again, to get to this, when you're in Robinhood, when you click on a premium cost to actually buy the option, underneath you're going to see basically a hyperlink to see more options. You click on that and it's going to show you these stats and the Greeks. The bid is the buyer, okay? The ask is the seller. So remember, we talked about this in the first video. An option is a contract between a buyer and a seller for the for the right, not the obligation, to buy 100 shares of the underlying stock, in this case DraftKings, for the strike price. So the bid is the buyer, the ask is the seller. And as you can see here, the buyers want to buy this options contract for $3.80, and there are currently 143 orders that are open that want to buy at that price. The sellers want to sell this option at $4, and there are currently 14 contracts that are open waiting to be sold at $4. Now, that makes sense, right? Buyers want to buy low, sellers want to sell high. It's just the way of the game. Eventually, they're going to have to meet in the middle. They're going to have to, sellers are going to have to come down, buyers are going to have to go up. That is where this comes in. This is the mark price. That is basically almost the halfway point between what the buyers want to buy for and the sellers want to sell for, right? And that's the premium price option that you're most likely going to see on Robinhood, is that mark, the place in between. Now, if you want to get in really quick on this option, right, you want to have this option, execute, not exercise, execute as soon as possible, you're going to have to pay closer to what the sellers are asking for. All right. If you don't really care, you want to get it as cheap as possible, maybe, set a price for closer to what the buyers are looking as the bid price. Right, so it all depends on how quickly you want to get in and out of this option. Now, if you want to get in and out really quick, right, you're most likely going to take a loss because you're going to have to buy it at what the sellers are looking to sell it at, and then sell it for what the buyers are going to buy it at. So in this case, right, the difference between $3.80 and $4 is 20 cents. So for 100 shares, it's $20. So to get in and out of this option really fast, it's going to cost you about $20. So just keep that in mind. Make sure you really want to buy this option before it gets executed, because if you have to sell it right away, you're most likely going to take a loss. Now, the difference between the bid and the ask, right? In this case, 20 cents or $20. That's called the bid-ask spread, okay? So what you want to do is you want to try to find an option that has a very narrow bid-ask spread. We're talking like 1, 2, 3, maybe up to 5 cents difference. So it's a $5 difference between what the buyers want to buy at and the sellers want to sell at, especially if you're thinking about trying to get in and out as quickly as possible. You want that bid-ask spread to be as low as possible. Now, there's other situations where you can let it go a little bit longer. You can let the bid-ask spread be a little wider. That's fine. It all depends on how you're trading. But for these purposes, you want to make sure that it's as low as possible, as narrow as possible. All right. So the previous close is what this options contract closed at, the value of the premium, the previous trading day. The high is the high, the low is the low for today, what the high is for this options contract for today, what the low was for this options contract today. Volume, all right, so there's, just use a different color here. Volume is the number of options contracts traded. All right, so that's the number of these this specific option that has been traded since its existence. All right, so in this case, 68. Open interest, right, we'll just call that OI, is the number of contracts open. So it's the number of contracts that the orders that people have placed to buy or sell this options contract that haven't been fulfilled or haven't been executed yet. So it's the number of open options contracts still waiting to be either bought or sold. Now, the open interest and the volume are going to fluctuate all the time, right? Because as buyers buy these options, as sellers sell these options, as things get traded back and forth, both the volume and the open interest are going to fluctuate back and forth. Now let's talk about the Greeks, and that is the section right down here. And again, we're not going to talk about Rho. It's too complicated. It's not going to affect anything that we're going to talk about today or your ability to trade these options. So we're not going to worry about Rho. So what we are going to focus on first is delta. Now, delta is the amount that the option is going to go up or down as the underlying stock price goes up or down $1. All right. So as the stock goes up $1, okay, the option premium is going to go up 55.59 cents or $55.59 because it's 100 shares. So if the underlying stock option, right, goes from, right, the example that we have here is $51.97. If that stock for DraftKings goes to $52.97, then your premium is going to go up $55 and you've made $55. If that stock price goes down $1, so it goes from $51.97 to $50.97, then your premium is going to go down $55.59, so you're going to lose $55. We're not going to get into gamma too much, but essentially gamma is how much delta changes every time the stock goes up or down $1. All right, so if it goes up $1, delta is going to change by gamma. So if the stock price goes up $1, then your premium is going to go up $55.59, but then delta is going to get reset by $4.28. All right, next we're going to talk about theta. So I talked a little bit about theta decay, right? So theta is the price you pay to play, right? So every single day that after you've bought this option, or every single day, this option is going to decay by 7 cents, 7.93 cents, $7.93. So if you buy this option, and we bought it, let's say we bought it for $3.90, $390. every single day, even if the stock stays flat, so it doesn't go up, doesn't go down, it just stays flat. It stays $51.97 tomorrow. Your premium is automatically going to go down by Theta. So it's going to go down by $7.93, no matter what, even if the stock stays flat. All right, so that is your pay to play, if you will. It's Theta decay. So when I talk about Theta decay in the previous videos, that's what I'm talking about. So that is your pay to play every day. Every day you can experience Theta decay. And then lastly, there's Vega. Now Vega is how much the premium is going to be affected by 1% change in implied volatility. So as implied volatility goes up 1%, then your premium is going to go up $5.15, right? Vega, or 5.15 cents, $5.15 for the 100 shares. So that's why I mentioned in the previous video how implied volatility is so good for options. So if implied volatility goes from 50% to 51%, your premium goes up $5.15. You've made $5.15. Now, inversely, if the implied volatility goes down 1%, then your premium is going to go down $5.15. Okay, so at this point, you should have a basic understanding and enough information to make you dangerous, enough information to understand how to start trading options in Robinhood. Again, it's a beginner's four-part section or four-part course. We went over a lot of the basics, some of the details, but I didn't want to overwhelm you with everything because I just want you to start getting your feet wet. And I think I've given you enough information over the last 4 videos to get your feet wet. Now, there's a couple things I want you to be able to ask yourselves and be able to answer after watching this video. 1, what is the bid and what is the ask? 2, what is the bid-ask spread? 3, what is volume and what is open interest? And then 4, go through the Greeks. Go through delta, gamma, theta, vega, and understand what each of them is, what they represent, and how they affect the premium or the options premium price. Again, please feel free to subscribe to my channel, like the videos, provide comments below, help me make this as better, help me make it as valuable as possible for you guys. And again, I really appreciate everybody's support. If you want to contribute and want to support the channel, feel free to use my referral link to Robinhood or share that referral link so that other people can get a free share of stock. I'll get a free share of stock. It helps support the channel, support my Discord group. You can find the Discord group link down in the description below as well. Or I also have a Venmo account if you wanted to support the channel that way. It's at Jonathan Van Horn. Again, really appreciate everybody. I hope this video was valuable for you. And until next time, happy trading.